All right, let's talk investing. You hear these terms thrown around all the time, right? Index funds, mutual funds, ETFs, hedge funds. It can sound super complicated, but what do they actually mean? And more importantly, how do you know which one is the right move for you? Well, today we're going to demystify all of it. We're going to break this whole world down nice and simple. Okay, before we get into all the different flavors, let's start with the most basic idea of all. What even is a fund? So imagine you and your friends want to throw a huge birthday party. Instead of one person trying to buy everything, you all pitch in 20 bucks. With that big pool of cash, you can easily get the cake, the decorations, the food, the whole shebang. A fund, it's the exact same idea. It's just a pool of money from a ton of people, all invested together. That's it. Simple, right?
So here's our game plan for this explainer. We're going to start with the foundation, that's index funds. Then we'll build on that, looking at mutual funds, hedge funds, and of course, ETFs. And at the end, we'll pull it all together so you can see how it fits into your own financial toolkit. Sound good? Let's jump in.
First up, the famous index fund. You've probably heard people on the internet yelling, just put your money in an index fund and forget about it. Well, there's a really, really good reason they say that, and it all comes down to how these things actually work. You see, the key to understanding an index fund is to know that it's kind of lazy, but in a good way. It isn't trying to be clever. It's not trying to find the next Amazon before anyone else does. Its only job is to automatically copy a list that already exists, a market index. No genius stock picker, no guesswork, just copying.
So what's an index? Just think of it like a top hits list for a part of the economy. The S&P 500? That's a list of 500 of the biggest, most successful companies in the US. The NASDAQ is the list for all the big tech giants. The Dow Jones tracks 30 massive industrial companies. An index fund just looks at one of those lists and says, okay, I'll buy a little piece of everything on there. Now, because these funds are just on autopilot, just copying a list, they're called passively managed. And that means there's no expensive human manager who needs a big salary. The result? The fees are ridiculously low. I mean, we're talking as low as 0.02% a year. To put that in perspective, for every $1,000 you invest, you'd pay just 20 cents in fees for the entire year. It is almost impossible to find a better deal than that. Now, here's one little quirk to know about them. Unlike a stock, you can't just buy and sell an index fund all day long. They get priced just once, after the stock market closes for the day. It's called the net asset value, or NAV. So if you put in an order at 11 in the morning, it doesn't actually go through until that 4 p.m. price is set. For a long-term investor, this is totally fine, but it's just something to be aware of.
All right, let's move on to our next tool, the mutual fund. Now, at first glance, they seem a lot like index funds. They're both pools of money, right? But there is one massive, game-changing difference: a human manager.
And this right here is the heart of it all. Where an index fund is passive, it just follows the list, a mutual fund is active. You've got a professional manager, sometimes a whole team of them, whose entire job is to research companies and handpick the investments they think are going to crush it. You're paying for their expertise to try and beat the market. Of course, that expertise isn't free. While an index fund might charge you a tiny fraction of a percent, these actively managed mutual funds often charge anywhere from 0.5% to 1.5%, maybe even more. That difference might sound tiny, but trust me, over decades of investing, it can add up to a huge chunk of your potential earnings. And here's the real kicker. This is the part that surprises a lot of people. Despite those higher fees and all that brain power, study after study has shown that the vast majority of these professional fund managers fail. They fail to consistently do better than a simple, boring, low-cost index fund over the long run. It turns out that consistently outsmarting the entire market is just incredibly, incredibly difficult. Okay, let's step into a completely different world now. Hedge funds. You can think of these as the VIP section of investing. They're definitely not for the average person. These are private, super exclusive funds for very wealthy investors who are willing to take on some serious risks to chase some seriously big rewards. See, hedge funds don't play by the same rules as everyone else. They use really aggressive and complex strategies. They do things like short selling, which is basically betting that a stock's price will go down. They use leverage, which is just a fancy word for investing with borrowed money, to magnify their bets. These strategies can lead to absolutely massive profits, but you guessed it, they can also lead to massive losses. And the fees? Oh, they are legendary for a reason. Hedge funds are famous for what's called the 2 and 20 model.
That means they charge a 2% management fee on all the money in the fund every single year. Plus, they take a 20% cut of any profits they make for you. It's a structure that makes them highly motivated for sure, but also incredibly expensive.
All right, let's talk about our final fund type, one that has become wildly popular in recent years, the ETF, which stands for Exchange Traded Fund. And the best way to think about this one is as a cool, modern hybrid that takes some of the best features we've already talked about.
Here's exactly why ETFs have taken over the world. An ETF gives you the awesome diversification of a fund, so you can own hundreds of stocks in just one purchase. But it trades on the stock market just like a single share of Apple or Tesla. You really do get the best of both worlds.
And this is the key advantage over those traditional index and mutual funds. Remember how they only get priced once at the end of the day? Well, with an ETF, you can buy or sell it at any moment the market is open, watching its price tick up and down in real time. This gives you way more flexibility and control.
So what about the cost? Well, here's the other great piece of news. Because most ETFs are also passively managed, they're just tracking an index like the S&P 500, their fees are also incredibly low. They're often right there with index funds and way, way cheaper than mutual funds or hedge funds.
So we've covered a ton of ground here. The best way to think about all of these options is not that one is good and one is bad. It's better to think of them as different tools in a financial toolkit. Each one is designed for a slightly different job. So let's do a quick recap with a little cheat sheet. If you want passive management and super low fees, you're looking at index funds and ETFs. If you want active management and are willing to pay for it, you've got mutual funds with their higher fees and hedge funds with their very high fees. And the biggest trading difference? Index and mutual funds trade just once a day, while ETFs trade all day long just like a stock. So what's the bottom line in all of this? Well, for the vast majority of us, for everyday, long-term investors, the simple, low-cost, and super diversified approach of either a classic index fund or a modern ETF is almost always the best choice. They are just about the perfect tools to get started and to build wealth steadily over time. So now you know the difference. You know how they work, how they trade, and what they cost. You can now make a much more informed decision for your own financial journey. So the only real question left is which one of these tools are you going to add to your kit?